So what you're looking at here, this black line step up is the active Fed funds rate, right? And what you're looking at from the red, purple, yellow, and green, basically from here up, is the front end of the curve. And basically, the best way to understand this, the most basic way, and I've talked about it a lot, is what determines what the 2-year yield is in the Treasury is where the bond market thinks the Fed funds rate will be in 2 years, right? The 1 year, where do they think this is going to be within 1 year, 6 months, and 3 months? And what we're seeing is rates collapse. In fact, the 2 year is saying within 2 years, they expect the Fed funds rate to be about about a percentage lower. That's 4 cuts. The 1 year is saying right now about 2 cuts. And now the 6 month is starting to go for the first time below the Fed funds rate, meaning that within 6 months they expect a rate cut. And the market celebrated that news in a big way yesterday. The Fed basically pivoted in front of us, said that inflation has been won, implying 3 rate cuts within a couple quarters, and the market loved that news. And so the question is the bond market, is that why bonds are being bought right now? That demand is going up. Typically, especially in the 10-year, what drives the 10-year basically further on in the curve is not what the Fed's doing, but what the bond market thinks growth and inflation expectations are within the economy. If growth and inflation are expected to go down, you want to own bonds in that environment, right? And so yields go down because people are buying bonds. Adversely, if there's an expectation of inflation or growth accelerating, you don't really want to own bonds in that environment because who wants a fixed rate when inflation is going higher, whether it be because of, growth or, the COVID fiscal stuff, whatever, But if we look back in time, every time that we've seen the Fed pause and bonds start getting bought, just take a look in 2019, 2018, Fed paused and they started cutting again in July of 2019. And we lived through this. Did they cut because mission accomplished? No. You go back through 2006 and 7, Fed paused in July of 2006. The market squeezed for a long, long time. And then they started cutting back in July of 2007. And did they cut because of, mission accomplished? No. And the same story is true in 2000. We saw this flight to quality, Fed paused, and they started cutting back in December of 2000. And it wasn't because mission accomplished. And so 2 things I want to say is the soft landing narrative. There's no instance where it's been done successfully when rates have been raised this much to fight a growth in inflation this high. So that's one thing I want to say, but that is a narrative that is going counter to where the trend is right now. And this is the other important thing I want to say. Right now, the market is pricing in a soft landing. Whether we believe it true or not, probable or not, doesn't really matter. What matters is that this is what's being priced in. And as you've seen, markets love to squeeze in the final rounds of a recessionary push, if that's what we're going into. And it can squeeze for a long time. And so the way that I am approaching this is, though I do believe the bond market is buying bonds not because a soft landing is going to be successfully met. I think that they're preparing for a recession. I really do. And that is my base case. But until the economic data stops supporting a soft landing, there's no reason to front run this move, especially now that this crash setup that we have been tracking for months has been invalidated. And so what we're looking for within the data to support or negate a soft landing is really a few things. One, this is U.S. economic growth that I'm tracking. There's a lot of growth, but this is just some of the metrics I'm currently tracking right now. We want to see a softening of this economic data. And if the economic data softens, what that means is unemployment will go up, right? So employment will soften. And as employment softens, it will allow the disinflation that we're seeing to continue towards the Fed's target. That is the path. Now, we don't want to see too much economic slowdown, and we don't want to see unemployment skyrocket. That would be recessionary. But as long as we can see a softening in those two elements, we currently have household checkable deposits at a pretty healthy spot right now. If you go back to where it was going back in 2000, back in the last year when we really saw the economy slowing down, it's not there. So the consumer does have enough juice theoretically to get us to the other side, as long as economic data doesn't collapse and unemployment skyrocket. That's the path to a soft landing. And as of now, the data we've been seeing for the last 2 weeks has been supporting this narrative.